Thanks, Rich. Thank you so much. I appreciate the opportunity. I appreciate both you and Dan giving me a chance to kind of visit with folks here. And so welcome everybody to the July edition of this grain marketing webinar. As usual, I'd like to start with a quick commercial. A lot of this started with Dan and I and Rich over the last year and a half, doing roughly 4-hour workshops. They're called Launch Your Pre-Harvest Marketing Plan. Basically, they focus on 3 common marketing concepts: the idea of setting market pricing targets, incremental sales, and decision dates. We share a lot of information. We play a lot of what ifs. We look at some different marketing alternatives. And the whole goal is to provide information and hopefully the confidence for folks to develop and implement their own pre-harvest marketing plans. We're not going to go into as much depth, say, in a webinar as we might in those workshops. And so sure would encourage folks to contact your local county extension agent about trying to get one into your county or your location. Our corn, soybeans, or a grain sorghum one could be done. Typically, we like to do them in December through February. We kind of start these plans, say, as of January 1. And our wheat ones, we'd like to do those fairly soon here, August, September, October, with really kind of a kickoff date of September 1 for the plan. So sure would encourage you to get a hold of folks and see about scheduling some of those this fall and winter. In our webinar description for today, one of the things we talked about was we mentioned, sharing a representative scale-up pre-harvest plan, kind of applying these concepts. And so I'm going to real quick here, just get my face off of there and run through that real quick. Basically, we've been kind of working, we've been doing these webinars since March, and we've been outlining about 3. We have a 2022 corn plan where we had 6 40-cent per bushel increments that we were trying to market based on the 15-year seasonal index of prices. Currently, that plan is 67% priced, so 2/3 priced. The 2022 soybean plan, we had 5 50-cent per bushel increments, and currently that plan, just kind of following that thing through, is 60% priced. And then in May, with the high prices that we saw there back in May and June, we started to start taking a look at the 2023 plan, because we thought, man, at these prices, we ought to be taking a look at 2023 wheat. So I call that a tentative plan. And there initially we outlined about 5 50-cent per bushel increments. Currently, that is about 20% priced. And I might run through them all right now, just quickly, kind of a timeline as far as in tracking prices. So as of yesterday, and the last time I looked today, I saw wheat futures were down. Everything else was pretty mixed, I thought, last time I looked. But our plan, we began January 3rd of 2022. December futures were $5.48. And at that time, we had an expected cost of production of, say, $5. And so we thought, let's get some initial sales on the board at any time we could get prices or futures at $5.50. Immediately the next day, we hit that. So we had our first increment priced at $5.56 a bushel. Our second one, which is 40 cents later at $5.90, clicked in on February 11th. At that point, we've got a war beginning. Grain stocks are getting tight. So come March 4th, we said, we got to slow this thing down. So we rolled our marketing, our pricing targets forward. So our next one would have been, right, about 6:30. We said, hey, let's wait until 6:70. And then so we rolled all of them forward. Well, that one clicked in March 23rd when we locked in a 672 price. April 8th, we rolled those forward again, looking for 750, which we hit April 28th. We haven't rolled that thing since. So that's where we are on the corn. We're 2/3 priced at an average CME December corn price of 644. Which if you assume a zero basis for corn at harvest, which I don't think is a bad one. I know forward contracts are into that in some places, but I think we have a good shot at stronger than average basis come harvest. That's $1.44 over our estimated cost of production. Our next targets are July 15th, which is today. And so we'd be pricing at $7.90 if we see it or not. So we'd be taking whatever price we close today, and that'll be that fifth increment. Next increment would be 8:30 or August 15th, and that kind of hits that prime growing area or that prime time for pre-harvest sales on corn. On the soybean side, very similar playbook. January 3, we're at 1283. We had our pricing target initially at 1350. We hit that fairly quick. We hit the next one, $14 very quick in February. So we did the same thing. We rolled those forward February 10th. March 23rd, we hit that at 1508. Rolled them forward again. And at this point, we're kind of waiting because that would have pushed that thing clear out to a bit. I think about a $16 target. We have not hit that. And our next date target is August 15th. So that's where that thing stands. We're at $14.25, our average futures price, $5 over our estimated cost of production. So, this whole concept of a scaled up pricing plan isn't, terribly off the books. I know some of these positions, especially some of those early ones, a person's collecting some margin calls, and obviously that is not a fun situation. But given the price, we've seen some things knocked back down, and these positions aren't looking bad. And the bottom line is we're always trying to price above our cost of production. So even though we may be getting margin calls, that cash price is offsetting that. On the wheat side, again, this is earlier than we normally start, but when you see $11, $12 futures, we felt like it was time to start taking a look at the 2023 crop, even though it's earlier than we normally would. So May 16th, it was 11.86 We had a target initially of, I want to say $12.50 or $12 or June 15. We did not hit that $12 target in this thing. We started turning lower, but it did hit it on January 5th, and we did lock in at 11.02, or the plan would have locked in an 11.02 price. And so that's kind of where we're at. We've priced 20%. Our next target is August 15th with a target price of $12.50, so we got a ways to go to get to that. I think when we first talked about that we said that was a tentative plan. We'd like to start that as of September 1, so we want to take a look at redo some calculations on our 15-year seasonal index, and when we start doing the workshops, we'll kind of outline that. And we also want to take a good hard look at what cost estimates were, because I've just sort of said, we just bumped up last year's initially, and I want to wait and see what kind of solid or more solid budgets we can put together and get a 2023 forecast of cost of production on wheat. One thing I want to talk about real quickly, and we've had some questions about that, is this whole concept. And I think at the last webinar, there were some questions, what can I do that's going to give me some upside potential, but help me to set a price? And the first question we get is, where will December corn futures be, right? They could be here, right? We can see this thing turn back around. Ending stocks all over. I think Dan's going to touch on that. We want to listen very closely when he does his outlook, but we do have the potential. Stocks are tight. We could also be down here come December, or lower or higher. This market is incredibly volatile. Just look at the past few days. We've gone from a low of about 570 something, clear back up to $6. So $6.60. So, over $1 in a matter of 2 or 3, 4 days. Still seeing a lot of volatility in this market. So the question, I think, from the last webinar was, how can I price today and yet take advantage of any major price rallies? Probably a shout out to Brady Huck, who had the question. I think he suggested, what about using a hitch to arrive contract and coupling that with a call option? Bottom line, I don't think that's a bad idea. Bad idea at all. But I don't want to get into anything really very complicated in this short webinar. So I want to start though with some background. When we think about fixed price alternatives or tools, there's really 3, right? We can use a short futures hedge where I call my broker and I sell futures, and that sets your price. And the only thing that's going to vary is going to be the basis. I could also though get a forward cash contract. So I work with my local buyer, my elevator, feed mill, whoever I'm working with. But in turn, typically what they're going to do is sell futures. Or I could look at a hedge to arrive contract, which is, I work with a local buyer, my elevator, a feed mill, et cetera, a feed yard possibly. But typically then they're going to be tying this to futures. So again, a lot of these fixed price alternatives, they're going to work very similarly, right? They're going to work very similarly because at the end of the day, they're all going to be tied to the futures market. Selling futures is going to allow you to market your grain post-harvest. So for anybody who wants to store their corn or feed their corn or put it in the bin home and sell it out over the winter, you need to be using futures because that's the one thing that gives you that option, or that ability, right? Forward cash contracts and hedge to arrives are going to require you to deliver at harvest. Selling futures also, though, is going to put you at risk of rising prices, margin calls. Forward cash contracts and hedge to arrives shift that risk to the buyer. So that's a benefit to those, a kind of a risk factor for selling futures. Selling futures also is going to subject you to basis risk at harvest. For example, what if basis is much weaker than we expected? If it's a stronger than expected basis, actually your futures hedge is going to work better. But if it's weaker then that even, that's a tough deal for that hedger. Forward cash contracts are going to lock you into the basis that's going to be offered at that time. So, you're locking in both basis and futures risk, which is kind of a nice thing. Hedge to arrives allow you to set that basis later, which is also nice because it gives you some flexibility to maybe wait for that basis to get a little stronger before you set that. So again, both of those help you manage that basis risk, but again, you're locked into delivery. And if you don't want that to happen, you got a problem. So, when we think about these three pricing alternatives, really the key is going to be, what are your post-harvest plans? Do you want to retain control of that? Do you want to feed that grain? Do you want to market that however you want? Then, that pushes you towards using futures. If you're wanting to deliver to the elevator, deliver to a feed yard, deliver wherever, working with that entity isn't a bad thing then with a forward cash contract or even a hedge to arrive contract. So that's the first question. The other one is, what is basis now? What is my forward cash contract basis and what do I expect it to be at harvest? So let's take a look at that really quickly. And again, basis all over the state of Kansas is different. Everybody's got a different situation. I'm going to look at one example, okay? This is a north central Kansas example from yesterday. Corn, their old crop basis was 85 cents over the September contract. So the price they were offering for a forward cash contract for 2022 was $6.90. I'm going to guess that, unless we're really hit by drought, and I was out driving in the country the other day, there are some pretty droughty fields. But if that's covering your cost of production, that's not a bad price. Now, over there on the right side, I've got the 3-year average basis that I pulled from KSU's Ag Manager website. Again, if you haven't gone there, it's a great place to get historical basis data. The 3-year average is 12 cents under for North Central Kansas at this location for this particular week, the second week of July. So typically we would expect it to be 12 cents under September. It's 85 cents over. We're 95 or 97 cents stronger than normal. Very, very strong basis for grain that maybe a lot of us don't have, right? Because this is the old crop. New crop 2022 basis, again, for this crop that's out there, is 45 cents under the December contract, or 5.56. Typically, we would expect the 3-year average basis says 27 cents. So this would suggest that it's kind of a weaker than normal basis. Soybeans, old crop basis, 80 cents over the November. So 14.21 for any soybeans that you can haul in today. Typically for this week 26, right, this middle of July, it'd be 56 cents under the September. And so if we, going back and taking a look at September, that's actually a 61 cent over the September, 80 cents over November, if that makes any sense. I hope it does. But again, either way, it's $1. Add that 61 over versus a 56 expected minus. Soybean basis is extremely strong right now for the cash crop. New crop basis 2022, 70 cents under. So given as a new crop bid of 1271, typically we would expect the 3-year average says at this location 83 cents under in that week 41 when we typically be harvesting our soybeans. That's week 41 is when Kansas is at 50% harvested. On the corn above, that week 38, that is when Kansas is typically 50% harvested with corn. Wheat, the old crop, 45 cents under September. So it's an 804. So if you've got some in the bin, if it's in the elevator, they're offering 804. Typically, we would expect 33 cents. So again, kind of a weaker than average basis on the wheat side. The new crop 2023, 66 or 60 cents under the July. So a 786 price, and we would normally expect a 34-cent basis for week 24 using that July contract. So again, kind of a weaker basis. Typically, when we think about basis, again, fixed price alternatives, whether you sell futures, forward cash contract, or use a market hedge to arrive contract, they're all going to work similarly. The key is going to be that basis. We look at a lot of times the 3 or maybe the 5-year average basis at the expected time of sale. That's going to give you your best estimate. Now, you can try to adjust that based on your expectations for demand. Maybe, hey, this year stocks are very, very tight. I think there's some reason to believe that basis will be stronger than normal. It gets tough, though, to how much do we want to fudge that stronger, I think. And so, it's a lot easier just to say, hey, what's the 30-year average? And let's go with it, knowing that it could be a little bit stronger. Something else to note, though, typically buyers, so your local elevator, your feed yard, whoever, that's going to be offering a forward cash contract or even a hedge to arrive, typically, they're going to turn and sell futures, which makes them then subject to these volatile markets. And the fact that, for anyone who has sold futures, what it's like to get beat around by margin calls this year. Our plans that we've outlined have incurred some pretty big ones. And I know there's some producers that have been plugged into these webinars who have also been hit by that pretty hard. Again, you want to stick with that because you're getting a good price, but nobody likes a margin call. The fact that, maybe my margin accounts are getting really strained, that can also contribute to a weaker forward cash contract bid. And I kind of wonder if that's maybe kind of playing into why we're seeing some of these weaker than expected basis bids for forward contracts because, folks are getting beat up and our lines of credit are getting tight. So I think that makes a little bit of sense. None of this answers that question about how can I set a price today and allow myself to take advantage of any future price rallies. The answer to that question is somehow tying in the use of commodity options. So a little bit of background here. Options are basically contracts that give the buyer the right but not the obligation to a position at a strike price in the futures market. Puts provide a sell futures position. Calls provide a buy futures position. They're flexible, just like futures. They're available ahead of harvest with standardized contract sizes and qualities. And I think a couple things to note. One, options manage futures price risk, just like the futures, but not basis risk. Another thing is, keep in mind that for every put, there is a put seller and a put buyer. And for every call, there is a call buyer and a call seller. If we use options, you've got to open up a trading account. And if you're buying it, you've got to pay the option premium up front. And note, they can be expensive. Put options alone are something that can provide a minimum price and still give you some upside price potential. Because again, they're giving you a sell futures position at a set strike price. So if prices go down, you've got the protection of that sell price. But if they go up, you can walk away. You walk away, you let that option expire worthless, and you're in good shape. Call options, which gain in value as prices rise, can also be a part of a minimum price program, a minimum price strategy with upside price potential when you're combining that with a fixed price alternative. And I think, again, a shout out to one of the questions we had at the last webinar. Somebody said, hey, what about buying getting a hedge to arrive and buying a call? Absolutely, that would work. So I've got 4 things lined out here. 1, you can buy a put. 2, you can short hedge, sell futures, and buy a call. You could forward cash contract and buy a call, or you could hedge to arrive. Work with a buyer, get a hedge to arrive contract, and in turn buy a call option. Each of those 4 above listed marketing alternatives will work similarly with the prior discussed basis issues, right? Whether I use forward cash contract, hedge to arrive, short hedge, whatever. Premium cost, and delivery issues impacting which one you might want to use. And so I'm not going to go into all of these just because everybody's got their own individual situation. And so really the best tool, the best strategies is going to be very individual. But by and large, these four are going to work very similarly. So here's a quick example. I've got a little spreadsheet that I like to mess with. And I used yesterday's prices. So again, I don't want to plug in because today markets haven't closed yet. This is the December 2022 corn. December 2022 corn closed at 601. Now I'm using a zero expected basis. Remember, we saw a positive basis for nearby and a 45-cent under in north central Kansas. I think part of that weakness is the fact that we're just seeing a lot of weariness on the part of buyers who don't want to put up with margin calls. And so, I believe there's a pretty good argument to think that in these locations, at least in north central Kansas, we've got a shot at zero. Now, again, a person could argue with that. Again, every person who's looking at this kind of analysis, you need to plug in your own expectation basis. But for this analysis, for this quick one, I'm going to use zero. So $6.01, adjusted for basis, adjusted for my hedge costs, that would give me an expected price of $6 a bushel. Not bad. I've got four put options. I had a $6 put, $6.20 put, a $6.40 put, and a $6.80 put. Combined with that, we've got all those option premiums. Yesterday, the option premium for a $6 put was 54 cents all the way up to the $6.80, which was 5.70. Those, if I adjust those, so I take the $6 strike price there under B1, take that, my hedge costs out, plus the cost of that option and my expectation of basis, which at this time is zero, gives me a minimum price of 5.45. And as you note, as we buy options that are more in the money, that $6.81 would be way in the money, I am increasing my minimum price. But look at what's doing to my cost. I'm paying $1.09 a bushel. And on that FAR B4, that's $5,450. So it's very, very high priced. Questions we got to answer are, can I afford these premiums? A lot of folks are going to say no. Do these minimum prices, right? The 5.45, the 5.52, the 5.59, the 5.70, and on that selling futures, $6, are these covering my expected cost of production? $6 for this crop, you got an amount might. One thing I like to do is very quickly say, hey, what happens if prices go up? So that's what this table does. It says, what if we go $7.01? So we see December corn at 7.01. Well, that short hedge, or because at that point, the harvest cash price is going to be $7 and a penny. My short hedge is $6 because now I've got $1.01 in losses, right? I lost $1 in futures and I had 1 cent margin, or not margin, but my hedge cost fees, say a penny. So $1.01 there in losses there. So 7.01 minus that is $6. My buy a put at the $6 gave me $6.46 because again, all four of those options with rising futures, all the puts expire worthless. So minimizing my premium dollars spent worked best. B1, right? Buying the at the money was really the best alternative here, just because if I did see the high price rise, I only lost the 54 cents and I was able to grab a little bit of that. It was better than, say, short hedge, but not nearly as good as doing nothing. Now, what would happen if futures go further down? What if we go to 5.01? At that point, the harvest cash price is going to be $5.01. My hedge price stays at 6. So because I have 99 cents, I have in futures gain. All of these options with declining futures, the puts are going to gain in value, right? That the $6 put there, B1, has option gains of 98 cents. So essentially, I bought it for 54 cents. I was able to sell that thing back for 98. I add that gain to that cash price at harvest, and I net out at 5.45. On the other end of that spectrum, the 6.80, I paid $1.09. I was able to sell it back for $1.78. So I did realize that higher minimum price of 5.70. So again, options are one way to keep your the possibility of a better price. But the question you got to answer is, do these minimums cover your expected cost of production? I'm going to finish up with this. As we manage these pre-harvest marketing plans, a couple things here. One, keep it simple. That's what I'm trying to do in this webinar. Focus on what you control. Has weather impacted your expected production? Again, I was out driving the other day. Some of this 2022 crop corn isn't looking very good. If you haven't gotten too many rains, on our plan right now, we're 67% priced. Well, has declining expectations for yields, has that made me 100% priced or 120? So always be reassessing where you stand. Keep your lenders informed and work with your broker and your marketing consultant. Definitely some of these more advanced things, fixed pricing mechanism plus a call. These things can work great, but again, I sure would want to be working with my broker or my marketing consultant on those very carefully. With that, I want to thank you for your time. I'm going to turn this thing over to Dan and take a look at what some of the questions again. Thanks so much.
I really appreciate, Mark, the info you presented, and would say that when we look at options, I have just a couple responses. First of all, they're always a second best to one or the other. Again, as we looked at the two scenarios there that you had, that either the price going up or the price going down, you could always have done something better, but it is a way to mitigate the issue we run into this year for quite a few folks in terms of margin calls. And there's in the economics market literature, and risk management literature, there's something they call fat tails, and those they have to do with the probability distributions and what we really expect could happen on the in the extremes. Not so much a normal type of a market, but what could happen if we get a lot of volatility in either direction. And so I think the reason we judge or we view options as pretty costly is at right now the cost, if it's I'm looking at on another chart, another screen, D's corn puts at the money 54 cents. We judge that as way too expensive generally, but if we were to stay in these type of volatile markets that we've just been looking at for a period of time, and we're gosh, $2 or more moves, like, or $1.50, it would be our expectation. Then suddenly, 40, 50 cents isn't as much of an expenditure. But right now, I think the experiences we've had getting here would tell us that, gosh, 54 cents is a lot of money to pay, just because we just don't expect that much volatility. But again, stay tuned. We're in such a situation in terms of supply demand issues going in this year and potentially going forward that it'll be something to see whether we get to the place where we don't view 54 cents a bushel for D sitting here in July as too much. So let's go on. So in terms of the factors we'll be looking at, of course, to look at we're generally dealing with supply demand issues, and even with the changes that have just happened in the grain markets as they've come down, I think largely in response to what's been happening to broader financial markets. I don't know that we've necessarily resolved the Ukrainian situation, but at least it seems to be more expected now. We hear rumors of some potential gains of benefits in that area of trade, et cetera, but we haven't seen that many changes in the overall situation that we had from that long ago. But we do see almost a fatigue in terms of the volatility that we were dealing with, and now just more of a wait and see. And I think as you look at the participation of traders, particularly spec traders, and often some of these futures that if they've just withdrawn because they're not quite as fearful as they were, then that's probably part of the effect that we're seeing right now in the grain markets. Let's see here. And we'll look at corn, sorghum, wheat, and soybeans in order. I do want to talk about in the grain markets, corn in particular, the type of temperatures that we're expecting to see, that we have been having in parts of the Western Corn Belt and are expected to see in coming days. Here is a mean max temperature anomaly forecast for July 18th through 22nd. So we're coming up to a time frame right in the heart of key corn reproductive stages, where again we're looking at tasseling, pollination, and you can see in that yellowish part of the country, which is pretty hefty part of the Western Corn Belt, including Iowa, Minnesota, Missouri, parts of the east, central and east. So we have risk in these markets. And when I look at the numbers that came out of the USDA's projection in the WASDE reports for corn production, they followed their normal pattern of staying with their trend line yield. Projection for corn happens to be 177 bushels an acre, same as last year. They'll stay with that number through at least the August report, and probably they may stay through even longer than that, because they're not in the fields anymore as of a year ago measuring yield potential in August. They don't do that till the September report. So if there's a question that people can have about the corn market supply demand numbers, probably has to do with the yield and the impact of the high temperatures we're seeing right now. Just to look at the U.S. Drought Monitor, again, we have a tale of two halves of Kansas. To the west, dry, and pretty much normal to the east. You see other states affected. This predicted soil moisture anomaly chart probably says more than that drought monitor, where you can see again the western half, arguably 2/3, southern part of eastern Kansas, all pretty dry. Note the dryness in Iowa, in Illinois, southern Minnesota, good chunks of Missouri, especially, and also down into the corn producing areas of the southeast. So we have dry conditions to deal with. In terms of short-term objective drought, again, the latest numbers I could get hold of from NOAA sources. You can see, again, the area that we're in that's most extreme in terms of dryness in the western part of Kansas. No small thing. But note also the moisture we've got up into the northeast areas. Now, there's a projection of these areas, which are growing spring wheat crops right now, having a pretty dry spell in the next couple of weeks. We'll have to see on that. But part of the wheat numbers that generally optimistic yield scenarios for white wheat, for spring wheat, et cetera, had to do with the moisture they've had up into the northern plains and Pacific Northwest. Well, if we turn dry in parts of that, we'll see what that does to yield and the wheat market. And of course, looking a little closer at this area in parts of Iowa, northeast Nebraska, southern Iowa, and again, important production areas up into Minnesota, Wisconsin. You can see some challenges, and also again, Indiana, eastern Illinois, and that the major production, they're not as major as a heart of the Corn Belt, but in the southeast, they still on the margin affect the amount of corn we'll expect to see. So because of this, because of the moisture issues that we have, and also the temperatures that are coming on, I think we have unresolved questions in the corn market. And of course, corn we're focusing on July reproductive issues for corn. If these dry conditions would continue into August, we'd turn our attention also to include soybeans. Again, flowering, reproduction, pod fill, all happening then. So we're in the midst of a year has a lot of uncertainty. And even though futures have come down now, I think, Mark, in our marketing plan, you stand there and you look at this, and we've seen a decline in January as seasonally you might, in July as seasonally you might see. But what we had for August for marketing strategies is not off the table. It's not a foregone conclusion. We have a lot of uncertainty to deal with in terms of corn production and crop production overall here in the U.S. yet this summer. Just a note quickly, you can see the different areas around the world and that are generally considered major production. No surprise what we see in North America. We just talked about that. Reports out of Argentina, quite a bit of concern about their production, scaling back expectations. Brazil's kind of a 6 of one, half dozen of the other situation. Generally, they're positive about their second crop corn. In the last week, the World Grains Council and other international bodies have scaled back production expectations in Europe. And for the wheat market, that's a major issue in that with Ukraine not being much of a participant this year because of its various problems. A lot of supplies around that part of the world would be taken up by the EU. Well, they've had weather issues. Still, note generally pretty decent moisture in China, the dry area that had developed in India that affected their wheat crop, and a tale of the East versus the West in Australia. I just wanted to pull back up this marketing plan, Mark, that you'd had, in looking at that critter. You can note where we stand, and we've certainly fallen off. In a normal year, if we had great crop conditions, we'd think, well, gee whiz, we come to our key decision dates, we'll just play catch up sales and take what we can get. But I guess what I'm saying today is that it's there's a lot of risk and uncertainty going forward in the corn market.
Hey, Dan.
Yeah.
Got a quick question. The last 2 weeks, obviously, looking at your chart or looking at our chart there, 2 or 3 weeks, we've seen prices really fall. And again, I think you touched on that a little bit. Part of that's just, I don't want to say fatigue, but just, things status quo, and people get used to dealing with the tightness of the stocks as they are. And I think also declines in GDP and inflation are causing some concerns. But two, haven't we seen a fairly big or fairly significant liquidation by some of the managed money and some of the index funds and things like that? And I guess my point coming back around here then is, if you touch on all of these risk factors and the dryness of things, if any one of those kick in, and we see some of the money and some of the index money comes back into that market, what impact could that have on futures prices? Could it take out these tops?
Well, the answer is yes. There's someone, if you remember, Darren Newsom used to work for DTN, and I can't lost track of what Darren's doing now, but he talked extensively about the role of money flowing, of capital flowing into and out of grain markets. And he was so focused on that, they didn't give much credence to fundamentals, supply demand fundamentals, which I disagree with him on. But that the idea of what you just talked about is entirely consistent with the views of what we'd expect to see from managed money, spec traders, recognizing a buying opportunity and going in or not. I do on some other slides not set out in the original presentation. I hope at the end here we can get to them. That in looking at what decline we've seen, at least through, I think it's July the 5th, we hadn't seen that much, surprisingly, not as much net exit from the long positions as you'd expect. And we have seen some. I guess the conundrum is, yes, the long positions have declined some, but the bearish positions, the sells, they haven't really increased that much. So it's almost as if people said, okay, it's maybe not going to run up, but I'm not going to bet on it going down yet. so maybe that would say they just exited the market because there's not a one-to-one change in those positions. So here at the very end, when we get to questions, I'll bring that up quick and go from there. So we move on. Here we go. So again, and because of time, I'm gonna move pretty quickly and just hit high points. And you do have the slides. Note the gains that we had basically from last February for the fears in the market, all manner of things. We basically have come back down to about 605 on yesterday. I think we're down 3 or 4 cents today as I look at that for corn, at least currently as I look at another screen. So we've lost from about 780, 775 down to 605, and are sitting on mid-July, and still have to weather really crop condition worries. So it's not a done deal that we're going down yet. We're going down from here into harvest, in my view, just because of all the weather issues that we're looking at. I did want to bring this up. You look at the what we had for what the futures were saying in terms of prices last year. You can see that pattern we had, big run up in the spring, coming down lower since then. We had a season average price by my futures calculations about 585, not far off of what the USDA is saying. I think they're at 563, something like that. We'll bring that up in a second. But the new crop futures have dropped in the last couple of weeks as a price projection sharply, down to 545. Now the USDA in their projection, they're looking at 595 for US price for this marketing year, and still at 665 for the projection for next year. So if the futures, but if there's a weakness in this, in the way I'm looking at this with futures, I'm taking current basis levels and projecting them forward. So the last basis numbers that we had, we take that on futures, and we go forward from that. So with that idea, you'd be at 545 for next year. But the challenge is, though, I think, Mark, I invite your comment on this. Your comment when you said that basis right now is really strong. Well, gracious, when you look at what's happened in Salina the last couple of weeks, as the futures have fallen off, this to me, this happens to be Salina, Cargill and Salina. Go to Garden City and see even stronger basis run up. The cash markets are still wanting corn, and apparently are marching in a different step with what the futures have done as they've fallen. So that's an indicator to me that underlying demand's still there. Basis is picking up the slack, or adjusting for the falling futures. And we still have pretty strong underlying demand, at least now till we get a new crop in these areas. So strong basis moves. And I would say, and as we sit here in Kansas, if you look at the yesterday's report on for what's bid at ethanol plants here in Kansas, this 150, if you can see my cursor, 150, that's $1.50 over futures for cash bids. We have the strongest set of cash bids if anywhere in the nation in Kansas. You've got some pretty strong bids elsewhere too, of course. And Nebraska's pretty strong, Missouri pretty strong. But so I guess my point is that yes, the futures have fallen, but the cash markets are pretty strong. And Mark, if anything, on our marketing plans, probably need to be all that much more aware of what basis volatility may do to those new crop bids that we've got for forward contracts. Just because right now it's not that they're the futures and cash are dissociating with one another, but the futures have fallen off. The cash and the local basis bids have shown a lot of strength to the other side, and almost talking about almost two different stories. Just want to show you this. You can see kind of supply demand numbers and interest of time. I don't want to spend a lot of time on that, but I do wonder about that corn yield number at 177. Of course, the came out of the June 30th acreage report and had about 500,000 acres more of corn interpreted than we had expected. So that was interpreted as well as a response of corn producers to corn marketing opportunities, and had kept this yield, the yield at 177, given all the issues that we just were talking about. So I think this is a big question that will over the next 30 to 60 to 90 days will be answering what the actual yield is on those planted acres. And because the yield's in question, then the production numbers in question. Again, 14.505 billion bushels projected for this year by the USDA, and if we appreciably, significantly drop the yield below that 177, then again, you look at those balance sheets, about 14.7 billion, 1.47 billion carryout. If we're 250 million, 500 million bushels high, then it doesn't take long to get down to 1.25 billion bushels carry out and pretty strong prices. And just wanted to show you this ethanol production generally still on the blue line on the bottom, moving along pretty well, and stocks up and down had been trending down of late. Exports not doing too bad. Really, the second strongest year, and in terms of pace that we've seen of late, but still not this as strong as last year. So we're kind of myopic in terms of what we're comparing it to. I do want to show the outstanding corn sales, who we're selling corn to China, to Mexico. Note here that in terms of projected exports, United States still is greater than Brazil, but also note over here, you wonder what the impact of the Ukraine-Russia war is. Well, before this war, Ukraine was sitting, they'd gotten to 35, 40 million metric tons of exports in their top year, but 20, 30 to be counted on. Now they're down to 9. So there's an impact of that war upon Ukraine's ability to participate in the world market, and it just tightens up the pie. Ending stocks, you can see the USDA's numbers of late, and again, I've already said I question the 177, or at least I shouldn't say I question it. I think there's a lot of uncertainty about that number. So come in with some alternative scenarios to consider and what price impacts they may come about and bring about. I put the USDA's projection just because of these yield issues at about 40% chance of being right, and start looking at lower yield scenarios to see what price impact they would have. And so you can see that in this table form for the details, but you can see it here graphically also. It's 10.1% USDA projection, and generally, if you start whittling down that yield, you get ending stocks with reasonable assumptions, I hope, for usage. 9%, 8.7, 7.6. You can see you're adding dollars to the price. I did want to say for corn that for corn supply demand figures that we're at latest projections about 312, 313 million metric tons, 26% stocks to use. And of course, the year that we're comparing to is not so much last year, it would be 2 years ago when I just get down to 293 million metric tons carry out and things were tight. And note that this projected 2023 marketing year is really backloaded. A good chunk of it is in terms of, whatever we get for the US crop, and then the Brazilian, Argentine crop harvested out in in our spring months. So it's a projection with a finger in the wind, is which way is the wind blowing, what they expect to see. And I think amongst my colleagues, Greg Eibendahl and Mark, I know you've talked about this also. We have fertilizer issues that haven't been resolved necessarily or completely, and other challenges with cost of production, inflation. So we're making a projection that everything will be tremendous out there, but that there's still a lot of uncertainty as to whether that actually happens. And take a look at this from a world less China point of view, which actually people probably preferable given the uncertainty we have. And my good colleague Guy Allen is really kind of an expert on the vagaries of China stocks. If Guy's on here, anyway, point being that we're basically outside of China in pretty much a sideways situation in terms of stocks, and not that far in any one year of having problems that would drive us higher on the grain markets. Did want to take a quick look at grain sorghum. Again, you can see a current projection of 615. For this marketing year, then for the next marketing year, 558. And here's where the USDA projections for next year and what the futures market are saying are starting to part ways more. New crop projection for wheat, and this excuse me, in 22, 23, I think I have the wrong titles on. This is right now 22, 23 as of June 1. This is the current marketing year, so my mistake. So that 21, 22 is old crop marketing year. New crop or is basically the current year. 655. The futures right now, given the bulk of the months stretching out in the future, down the road for the deferreds, 558. Basis so for excuse me. I think I just got my wheat. I was trying to think ahead to wheat. I got my grain sorghum mixed up. So we're in the right marketing year. Excuse me. Grain sorghum basis moving sideways, not reacting the same way as corn. Exports kind of bumping along decently. Not too bad a year, but not setting a record. Most all the business is coming from China, and you can see the reliance of grain sorghum market on exports the last several years, especially. And you look at the whole world less China stocks to use for coarse grains. Plug the U.S. grain sorghum price in, adjust it for the U.S. dollar, and so in our marketing year, if we see a 655 here in the United States domestically, the rest of the world sees $8 for the price they pay for U.S. grain sorghum. Interesting. Well, we're pretty tight here on time. We'll go forward and hit high points then. Here's that wheat marketing plan. You can see again, we're about 20% priced. Mark, do you have any comments on this? I'd heard what you said before. We've come down quite a bit, and there are targets are 1250, 13, 1350, 14, and we may be in this marketing year driven more by what we do on the dates than achieving those targets. What are your thoughts?
I would agree. And again, this is a tentative one because typically, we kind of like to start those and do most of your sales really Jan, Feb, March, as opposed to this far in advance. But the market was giving us this opportunity. But I sure would agree we might see that. But, to your point, anything can happen. Stocks are incredibly tight, right, on the wheat. Yep. There's a lot of dryness. I mean, we don't know what the European crop is looking like over there. Things could really change very quickly, and we might get some of those opportunities to grab $12.50, $13. You don't know that for sure, but you're right. I think the time things are probably going to drive it more. Yes.
But just really interesting how when about a month ago, with all the fear and uncertainty about Ukraine, we talk about these with a lot more optimism. Now with what we've just seen, we talk about them with a lot more pessimism. We're kind of myopic in that, but let's go on and see some of the issues. You can see that the move that's occurred in the wheat markets. This is on the September contract. again, given back almost all of that gain that we'd seen since mid-February. You can see the current marketing year about 778 would be the futures number. For the next one, 757. And so again, here you do see quite a difference in opinion between the USDA's numbers and what the futures are saying. 1050 according to the USDA for the next marketing year, 757 by the numbers I'd be looking at. So I'm not sure what to tell people with regard to marketing in a situation like that. If we look to the USDA's number, we'd probably be pretty optimistic. But right now, and again, with what's just happened in the wheat market, we've taken a major turn towards pessimism. Basis in Salina, hard red winter wheat, moving along sideways, not a lot of change. Had down southwest Kansas, Hugoton area, Perryton Equity Exchange, Periola. Again, just so. In fact, a little bit weak of late. Let's move on here. I want to get to the international issues for this is important. In our wheat market, if we had stronger U.S. Export movement in wheat, it would make a world of difference. I think in terms of what traders in the U.S. who are trading on these major exchanges are willing to price. We're running at the slowest pace now in the last several years for wheat exports. Now, a fair amount of that's probably due to the high U.S. dollar and other opportunities around the world to buy wheat. And to me, the $64 question on the wheat market is when do things get tough enough from Ukraine, from Europe, from wherever, to where countries find it profitable to come to the U.S. even with all our cost disadvantages and buy wheat for import purposes. And we've been struggling to find where that's at so far. Excuse me. Okay, and so you can see the again, top wheat exporting countries. We still are about the fifth highest country. But again, you can see the impact of that Ukraine-Russia war. Ukraine was they were battling Canada and let's see, I think is that Australia? Yeah, Canada and Australia for the third or fourth spot. Now they've been hurt appreciably. So again, Ukraine-Russia war has sure impacted the world wheat export market as well as for corn. You can see the USDA's projection, generally tightening stocks still, high prices, 1050. Again, it's just it's sobering to me to see what the futures are thinking right now. They're thinking of something similar to last year, whereas the USDA is projecting something higher. And I'm looking at this, I guess I'd hang my hat more on the USDA's numbers just because that's how things line up historically in terms of supply, demand, and price responses. You can see a projection here in terms of where the markets may go. And on that last scenario, do have lower U.S. exports yet, 750 million. And if you get to that from where we're sitting right now with their projection, at 800 is not great. But if you take that much more demand out of the market, then you're closer to 850 probably, with lower yields from dry conditions that we just talked about earlier in the Pacific Northwest and Northern Plains, and or higher exports. Then yeah, you could move higher from here. But you'll have, apparently with the mindset of the market, you'll have to be shown that that's actually occurred. Right now, the fear of that isn't in the market. And so you can see how that looks graphically. World wheat usage, generally, I know we've been kind of so on where wheat prices have been in terms of late, but still, if you take $7 to $8 wheat as a tremendous price, then you can see how we got there. We've been whittling down world wheat ending stocks for a good while now. In fact, this last number for the 21-22 it'd be, yeah, 21, 22, 22, 23 marketing year is an 8-year low. And for world less China, which is, again, as we talked about, still a more accurate way to look at things, probably, we're at a 15-year low in terms of 126 million metric tons and stocks, just under 20 stocks to use. And in essence, we're the lowest we've been, the tightest we've been on the world wheat market since back in 2007, 2008, which is really kind of a bellwether, a watershed year for things being tight. So, Mark, this is consistent with what you'd said, that things are really tight in the wheat market. And with that type of tightness, and when we see prices come down, it's hard for us to cognitively accept that, but yet that's what's happened. You can see how that looks charting wise. We're basically shooting to the high side. 1050 for us in the US. By the time you adjust for the US dollar, is 13, just under 13. So that's part of our issue in terms of moving wheat. The high value of the US dollar really affects wheat. And for soybeans, just to finish up here, Mark, invite your comments on this. Again, I see where we're at on this chart. We still have targets of 16 and on August 15th, 17th for September the 15th. And a lot of times you'd say, well, gosh, that's awfully high. We haven't even in our highest on this chart that you're showing here. We haven't gotten to that. We did for the July contract, I think, get up to 17 as once. But so for this to happen, I'm thinking that you'll have to have dry weather continue off into July and affect the amount of production that we have. Again, affect flowering, pod set, and the like. Any comments?
No, I think that pretty much stands on its own, and I agree 100%. It's unfortunate that we've seen prices fall like we have, but I think as we work this plan, I think just as we talk in the workshops, you kind of set those targets, and I wouldn't have any problem at all waiting. Let's see if we can get a bump up here in August. And these are pre-harvest plans. It doesn't have anything to do with what you want to do with that crop post-harvest. This is only one half of that marketing. The other part I would always throw in here is obviously, as we create a plan and we we're 60% priced. Take a look at what your beans look like. If you're in some of these areas and you don't have it under irrigation and it's gotten dry in Kansas, or as some of your maps are showing in the Corn Belt, we may be, way closer to 70, 80% priced with this level of action that we've already taken. So people need to keep that in mind as they develop their plans.
If we do end up in decline into harvest and you're forced to take to do something by this plan on August the 15th or September the 15th, still, if the trend is down, those will still end up being better, very likely be better than the outcomes you'd have as you if you remained completely unpriced. So when you don't reach the price goals, you're looking back in this kind of quasi-disciplined plan to have the calendar dates drive you to take what you can get and probably end up and be thankful you did, but by the time you get another 30, 60 days down the road. Let's move on. So again, to finish up then for soybeans, we've lost, again, it's not quite as bad a situation. You can argue that where we were in mid, well, our lows in coming out the latter part of January, we haven't quite declined all the way down to that. So arguably we're marginally a little better situation in terms of relative fall in the soybean market. And you can see again, there's the projection, current market year 13-17 by the futures. Model that I'm developed and using, 1302 for new crop. USDA is projecting 1335 for current. For new crop, 1440. So again, the recent fall down in the futures markets have affected what a projection based on them would be. And so you've got the USDA and the futures differing quite a bit. Basis. Now, Mark, you talked about strong basis, and note on this, we had been weakening, at least at this, important location in Kansas, but then in one quick jump, you can see we went from the lowest basis bid of the calendar year to the highest one in about 2 weeks. So interesting to see that. And when you have something like that, that's it can be a rollover of a contract that could be part of it. Could be between a higher soybean contract rolling off the board, a lower price new one coming on as they rolled that. So that could be it, or could also be export demand coming in at that particular location. And we won't worry a lot about that. You can see that we have scaled down our expectations for U.S. soybean planted acres, about 2.5 million acres. So that's a big deal. Still questions, I think, not quite as direct for soybeans as we had for corn, but there are questions about what we'll get for soybean yields. And those are, give us 2 weeks to get into August, and that's what we'll be talking about next. Soybean production, because the yields are in question, the production numbers in question. Exports, okay, not great, not as good as last year. Perhaps that's the big issue. China's still a major buyer, the major buyer. 51% of U.S. soybeans sold still going to China, and Brazil has surpassed the United States as a soybean exporter. And they had this projected marketing year. They're 53% of what's to go out and anticipate to go out, and the U.S. at 34. Note strong move to the high side for prices. It's interesting how the futures are basically coming up with prices that are about equal to last year in these commodities, whereas the USDA is still projecting a bit higher. And so with that, you've got some scenarios of lower exports. And in combination with lower yields and lower yields yet with less exports, and trying to maneuver through that setup. So when you look at the potential outcomes, you got 1440 projected by the USDA, and scenario if you increase the carry out a little bit because of the way the scenarios work out, prices closer to 13, but generally I've got there about 25% chance as you think through scenarios, the likelihood of them occurring, the price is closer to 15. So, you look at that, and I guess I'm generally a bit distrustful of what's just happened in the grain futures, based on the impact from the that I think largely has come over from the financial markets, general malaise in terms of being involved in commodities right now, fears about inflation and recession. But when you look at the supply demand balance sheets and the risks they're facing, there's still a lot of opportunity for prices to just on a supply demand basis, fundamental basis, to be strongly supported just because of tightness of supplies. And you can see the world soybean usage. Let's just jump right to, we'll take a look at the world minus China soybean usage. And this current marketing year that we're in, the 21-22 that we're finishing up here, 11 is an 11-year low. That's at 58 down there for the ending stocks. So we're sitting tight, real tight for soybeans. And you can see, of course, what this has done with us for prices, and we're looking to the 1440 the USA projects is just under 18 in the world market, given the high US dollar. Very good. My apologies for going over. Are there any questions we can address that are coming in from the floor?
Folks, go ahead and put anything in the chat there that you might have for Dan or for Mark.
While we're waiting, why don't I show you what's at least Mark, we had brought up what traders are doing. Let's take a look and see. Got the net positions of traders for corn. Figured out this latest numbers. There'll be more newer numbers coming out tomorrow on Friday afternoon. But so you can see the net positions of managed money traders specs that we're kind of watching closely, and they, in general, the net long position has declined during this time frame. But when you isolate them, you can see that even more, that the managed money long traders, the long specs, those who are in position when prices are going higher, they've lost about arguably 45%. But what hasn't happened, in my thinking, is that the short positions haven't really gained that much. So it's like we're at a point of observation to see which way we want to go. Net position for hard red winter wheat, again, that has also declined some in terms of on the red, the net position between those long and short. When you break out the longs and the shorts, again, we've lost about half of the upward optimism in the wheat market, but haven't really started to, in any gangbusters way, started to really invest on the market going down much. So interesting. Net position for soybeans, again, you can see actually for soybeans, there's been some decline, but not near as much in the managed money specs position on beans, still holding up pretty decent, and if anything, holding up stronger for the long position on the straight out managed money specs than for the other commodities we just looked at, and only a small modest increase on those looking at the downside. So we try to peer into the psyche of these people and figure out what they're doing. So prices have come down, but they haven't jumped in and started to be bearish yet. They're not as bullish, but they haven't been committed to being bearish. Anybody have any thoughts or comments on that?
And just one, I've heard it postulated that part of that of the managed money pulling out of the commodities is sort of out of, quote, the recession playbook. That during recessions, one of the best plays for a commodity manager or a managed money person is to get your money out of commodities. I don't profess to know enough to have an opinion, but I was kind of curious as to your thoughts. If that is what we're seeing, and some of these folks are saying, oh my gosh, we're going to see a recession, not just in the US, but worldwide possibly here as inflation's going crazy, we're tightening up money, et cetera. Even if we do see some of the dryness play out, we start seeing minor but still significant reductions in potential yields. Do you think those folks will get back in? Or do you think they'll stay out because, oh my gosh, we want to stay the heck out of the volatility because of our recession playbook?
Well, two thoughts. First one is that if we get tangible damage to corn, soybeans, those spring wheat, the wheat crops to the north, and we really start to see the USDA numbers start to reflect it, i.e., there's confirmation that would bring them in. That'd probably be for a little bit of a different set of reasons than they were in before, when they were more driven so much by Ukrainian fears, and just overall world food issues. So that's one thought. And the other would be, if the drive in a situation like this is to, quote, get the cash, get into cash quick. Well, you can get into cash, but we still have inflation. It's like, if we didn't have the inflation fears that we're dealing with right now, again, core inflation at 9% overall CPI, and that's adjusted for food and energy. If you take that out, we're somewhere higher. I'm not exactly sure. It's hard to find that number, but it's probably over 10 for sure. I did see where the producer price index was about 10.1, 10.3, et cetera. So at least 10% inflation. If you take your money out of the commodities, put it in cash and go sit on it, you're losing money. You're losing value because of inflation. So I think they've got a real conundrum. What do you think, Mark? Does that make sense?
Oh, yeah, sure does. Sure does. As you talk about the dollar or the cash, made me think about the fact that the dollar is incredibly strong. It's going to make exports. It's going to be a real headwind, right, for U.S. commodity exports. Do you have any thoughts on what that's going to do to prices and maybe basis? And obviously they're connected, but is that a big concern for folks, or is that not? The fact that the euro and we're equal at this point. Haven't seen that for a while.
Can you restate that question? I think I'm catching your drift and direction. So are you basically wondering how a move into a recession with loss of consumer confidence would affect the grain markets? Is that what you're getting at?
No, I'm getting at the fact that the dollar is incredibly strong right now compared to currencies. Again, we're equal with the euro right now, which typically, we haven't been that for 20 some years maybe. So I guess, and so that makes everybody else's exports cheaper and they're more expensive. Is that going to have a major impact on basis overall prices here in the U.S.? I mean, is that going to make us even more the seller of last resort, but in a short year? Because it's all going to get sold.
Well, for wheat, because there are other countries that can sell, a lot of them with a lot weaker currencies than ours. It just exacerbates the problem. Probably hits wheat exports worst of all. It would also, if all things were equal, it would also hit the other commodities, corn and soybeans and sorghum. However, the world just does not have that many places to go to get hold of those for export buyers. So it hits us most where we're most vulnerable on the wheat market, and mitigates what could happen for exports, for U.S. exports for the other grains, but it's the blow is softened just because of our comparative advantage in those situations. It kind of becomes a bidding war between the United States and Brazil for a lot of these things. And so if you look at the Brazilian real versus U.S. dollar, and you expect to see, well, gosh, the Brazilian real is really weak, et cetera. That's been their history. But they had instituted some monetary discipline practices to where the Brazilian real is not just terribly weak. Now, the Argentine currencies, given what's happening now in their financial markets and their economy, is probably going to weaken terribly. So that's what seems to be the signal. So Brazil still, it is not as far different as from us as you think in terms of currencies. So it's kind of mitigates things. But Argentina has a whole host of other problems, but they're going to have a weak currency, and that'll help their exports.